Welcome to the deep dive. Today we are cracking open a market brief from Friday, November 7th, 2025. And it's a day where, well, market sentiment was decidedly grim. If you're looking at the indexes, the NASDAQ is currently set to cap its worst week since March. This isn't just a dip, it feels like an environment of accelerating fear.
Oh, absolutely. And that fear is definitely measurable. For anyone tracking investor anxiety, we look at the CBOE volatility index, the VIX, Wall Street's fear gauge, right?
Right.
It's trading high today, 20.44. That's its highest in, over 2 weeks? It signals a real tangible demand for portfolio protection, a clear breakdown of confidence in the market.
Okay, so let's unpack this for you. Our mission today is really to distill the sources to figure out the why behind all this financial anxiety. Our research points to a kind of perfect storm, a toxic collision of two major crises happening at the same time.
Right.
First, there's this technical tech sell-off driven by skepticism around artificial intelligence. And second, this paralyzing macroeconomic issue we're calling the data vacuum.
Yeah, the data vacuum. So the goal then is to understand how the market operates when the lights are suddenly turned off, when that official economic data just vanishes, corporate earnings.
Mhm.
They stop being just about one company. They start being treated as like de facto economic reports. And this whole environment, it's perfectly illustrating a massive and frankly dangerous K-shaped divergence in the U.S. economy.
Yeah, where the top half thrives and the bottom half just collapses. That's the central theme we need to get our heads around today. But first, let's tackle the immediate driver of the sell-off. The E-mini S&P 500, NASDAQ 100, Dow. They're all decisively negative in futures. NASDAQ 100 leading the way down. What's driving this sudden technical rout? I mean, this is the most crowded trade in the world.
Well, what's fascinating here is that the primary pressure point isn't like a surprise rate hike or anything. It's what analysts are calling the AI valuation reckoning. Investors are aggressively booking profits. They're getting out of positions because there's growing skepticism over what they see as, sky-high valuations in key AI stocks.
And this is where it gets really interesting, isn't it? It's not just that the stocks are expensive. There's this sophisticated bearish theory gaining traction that actually challenges the underlying business model itself.
Precisely. The core of this argument centers on concerns over monetization and circular spending within the industry. Think of it this way. AI revenue growth might look explosive on paper, right? But if you actually dig into where it's coming from, a significant chunk of that capital flow might be an internal bubble.
An internal bubble, like siblings selling the same toy back and forth.
Kind of, yeah. It's like a small handful of tech giants, say OpenAI, Amazon, Microsoft, investing billions in each other's infrastructure, servers, software chips. They're fueling this massive capital-intensive cycle.
I see. So the theory is that we're mistaking these huge capital expenditures for real, broad, organic customer demand. If that's true, it drastically shrinks the perceived total addressable market. That's concerning.
It creates a fundamental vulnerability. Now, you couple that AI skepticism with the macro problem. Crisis number 2, the data blackout. We're dealing with the longest government shutdown in history, and that is just compounding the market's anxiety into something near panic.
Right, and the most direct impact of this political mess is the data vacuum. Specifically, the Bureau of Labor Statistics, the BLS, did not release the official October jobs report today, November 7th.
And that absence, it's paralyzing. That jobs report, along with inflation data, retail sales, that's what the Federal Reserve uses to set policy. Without it, the market and the Fed are basically flying blind.
Flying blind.
This uncertainty forces that critical shift we talked about. Investors have to look at corporate earnings, at management guidance to get any sense of macro clarity. It dramatically raises the stakes for every single report coming out.
And we're already seeing shocking evidence that this shutdown is inflicting real economic damage, especially on the U.S. consumer, particularly at the low end.
Yeah, this historic instability is being confirmed right now by the University of Michigan's preliminary Consumer Sentiment Index for November. It slumped sharply to 50.3. That's a 3.5-year low. But the really shocking stat is buried inside that number, the current conditions component. It fell to an all-time low in the survey's entire 73-year history.
An all-time low in current conditions. That's staggering, especially when the financial markets are, still only down a few percent overall. We need to drill down on this. Who exactly is feeling that pain so acutely?
Well, the research we reviewed suggests this historic collapse is explicitly tied to shutdown concerns tied to S&T food payments and ongoing non-payment of wages.
Yeah.
And just to be clear, SNFP is the Supplemental Nutrition Assistance Program federal food assistance.
Okay.
The market is worried the shutdown is literally preventing the delivery of basic necessities to the most vulnerable people.
Wow, it really feels like we're tracking two entirely separate countries within one economy. And we can see that K-shaped divergence playing out perfectly in today's pre-market movers, can't we? On the upside, you've got this high-end
That's
resilience.
the top arm of the K, exactly. Expedia, EXPE, is the poster child today, surging over 17.5%. Blowout Q3 earnings, they raised guidance, and their B2B growth was really strong, like 26%. This just confirms that the affluent consumer, the folks spending on travel, they seem entirely unfazed by all this macro turmoil. They keep spending.
Their financial assets are holding up.
Right. Their lifestyle is preserved.
And then you have the mirror image, the collapsing bottom arm of the K. That's Block SQ, the sort of anti-Expedia today, plunging 11% after missing on both profit and sales forecasts.
Block is such a critical proxy here. Its ecosystem, the Square terminals for small businesses, the Cash App for consumers. It's a direct, real-time pulse check on the health of small to medium businesses and the lower to middle income consumer.
So their miss confirms the University of Michigan data.
It does. The real economy, where basic income and small business revenue actually happen, it's contracting sharply.
So if we connect these dots, the market is confirming this dangerous split. High-end spending is fine, maybe even booming. But the foundational consumer, the small business sector, they're showing real signs of collapse. The problem is the financial economy, the stock owners, remain relatively optimistic, while the real economy hits a 73-year low in current conditions. That seems unsustainable.
That structural split places an immense, almost impossible burden on the week ahead. Let's look at what we're calling the macro data gauntlet for November 10th through 14th.
Okay, so we have key inflation reports scheduled CPI, PPI, but the uncertainty around them is huge, right?
That's the critical risk.
Yeah.
The high likelihood of delay. Analyst calendars list them, sure. But government-focused analysis we've seen explicitly states that reports from the BLS and Census Bureau, which includes PPI and retail sales, are highly likely delayed because of the shutdown.
So the market has to hedge against the unknown. That VIX probably stays elevated then.
Probably. Which means if that key inflation data is delayed, the market's left with only a few macro indicators. And those indicators take on enormous, almost disproportionate weight.
So what are the absolute must-watch reports then?
The focus narrows sharply. Two things. First, initial jobless claims on Thursday, November 13th. Because the main BLS jobs report is missing, this weekly number becomes the only official high-frequency look at the U.S. labor market. It's the stand-in.
Any significant jump there would be bad news.
Immediate panic, potentially. And the second focus is entirely on debt and government stability.
Okay.
The U.S. Treasury auctions, particularly the critical 10-year note auction. A weak result, meaning low demand for U.S. debt from international buyers or institutions, would send Treasury yields spiking.
And that yield spike feeds right back into the tech sell-off.
Instantly. It worsens the tech AI sell-off we're already seeing, tightens financial conditions across the board.
And adding to this domestic stress, we can't really look externally for growth support, can we? The global picture isn't great either.
No, not really. We need to briefly acknowledge that weak external environment. China is expected to report continued deflation and a persistent slowdown in growth. This matters because, for years, whenever the U.S. looked weak, investors could chase growth somewhere else. Maybe China, maybe commodities.
That safety valve is gone.
That luxury is gone, yeah. The U.S. market is forced to confront its own domestic problems without that external lifeline.
Okay, given that reality, let's move to our next section, the AI earnings referendum. Because it sounds like the market-leading AI theme isn't just delivering reports next week, it's basically standing trial.
That's exactly it. This is the central event. The earnings from key AI bellwethers, specifically Applied Materials, AMAT, and NVIDIA. This is the put-up or shut-up moment for the entire bull thesis that's driven the market for 18 months now?
Let's start with AMAT on Thursday, November 13th. Why is that one being called the canary in the coal mine?
Well, AMAT provides the really complex capital equipment to the chip makers. Think of them as gauging the semiconductor supply chain before the chips are even sold. Their guidance on future equipment orders. That's a direct forward-looking read on what the industry plans to spend.
So it's Predictive.
Highly predictive. A weak guide on capital equipment orders from AMAT would be a catastrophic forward signal for the whole AI and chip sector. It would basically confirm the bearish fears before NVIDIA even reports.
And then NVIDIA is the main event. What does their management absolutely have to do to counteract the skepticism that's already knocking the stock down? It was down 9% this week alone.
The market needs NVIDIA's management to explicitly address that circular spending narrative we talked about earlier. They have to provide concrete evidence, some proof, that their customer base is broadening out beyond that small handful of tech giants who might just be funding each other.
So even if they beat the quarterly numbers,
Even if they beat expectations, yeah. Failure to provide that proof of broader demand could instantly validate the internal bubble thesis.
Yeah.
And that could crash the entire AI momentum trade.
wow, okay. Now, Wednesday, November 12th, gives us another perfect A-B study of that K-shaped economy you mentioned. We have Disney, DIS reporting. That gives us a read on the real-world consumer, right? Theme parks, movies, streaming churn.
Exactly. And that contrasts really sharply with Circle, CRCL, reporting the same day. Circle issues the USDC stablecoin. Its revenue is a direct proxy for digital payments for the health of the whole crypto ecosystem, putting Disney, real-world leisure next to Circle, the digital economy. That's going to offer some unique insight into where capital and consumer activity are really flowing in this split market.
That's a fascinating comparison. Finally, we need to keep an eye on what you called the old tech recession check, Cisco, CSCO, also on Thursday, November 13th.
Yeah, Cisco. It represents core enterprise IT budgets, networking gear, infrastructure, security, the basics. If Cisco guides down significantly, it signals that the economic pain has spread beyond just the lower-end consumer we saw with Block.
It means corporations are pulling back.
It means corporate IT managers are cutting back on core enterprise spending. That would be a powerful signal of a broad corporate recession. That's a far more bearish event for the whole S&P 500 than just a localized wobble in, some high-flying AI stocks.
This has been a really insightful deep dive to try and synthesize this for everyone listening. The market is in a deeply fragile state. It's kind of data blind because of the political paralysis, and this state is dominated by that tension between the resilient high-end consumer Expedia's blowout results and the collapsing low-end consumer, confirmed by Block's failures and that shocking 73-year low in sentiment.
Right.
This K-shaped reality places this immense, maybe unprecedented burden on next week's earnings. They have to serve as our economy's true, albeit incomplete, health reports.
And that data scarcity creates risk, absolutely. But it also creates singular focus. If CPI and PPI are delayed, the market's attention will narrow right down to the most basic inputs: weekly jobless claims and the demand for U.S. debt and those treasury options. So given that the shutdown is keeping the official data hidden, ask yourself this: which single piece of corporate guidance next week? Is it Applied Materials, NVIDIA, or Cisco? Which one holds the greatest power to either amplify the fear and signal a broad recession, or maybe, just maybe, restore some faith in the overall direction of the U.S. economy?